$250 million in assets. We invest specifically in balance sheet light financial services across Africa and South Asia, with a balance more skewed towards Africa simply because the opportunity set is just larger there today, and also there has been a level of price inflation in South Asia. But the complementarity between the two regions is really strong. We have a very large operating network. Udayan will tell you a little bit more about that. We've got a specific focus on growth equity. So we will only invest in capital increases and in replacement equity in entrepreneurial-led companies. So the first point is obvious, and it's known by everyone. The income gap between developed and growth markets is enormous. When you look at high-income markets, effectively the United States and Western Europe, you have an average GDP per capita on nominal basis of $38,000. And actually, if you look at the United States, it's about $50,000. Compared to Sub-Saharan Africa, on average, 1,600. I think now, after the Nigerian revision, it's probably closer to about 2,000 on average. But even if you look at other countries, such as India, you actually end up at 3,000. So the income gap is enormous. And this has a very strong significance for the type of financial products that you can offer these people. Effectively, what you can offer people in the United States is not going to work by its very structure for a population with income level that are a tenth or less of the same. So the redesign of financial products is necessary. It's absolutely needed. It's not enough to simply shave down a few functionalities of a specific product in order to achieve a profitable and sustainable financial institutions or financial service. A second point that you're all very familiar with, but again it has an implication, is about the penetration of distribution networks, of last mile distribution, if you will, if you want to use a telecom kind of nomenclature, in banking versus the mobile cellular distribution. Now, what's really interesting about this is the ratio is 1 to 10 if you look at high income versus Sub-Saharan Africa countries. And it's only 1 to 3 if you look at mobile cellular subscription. Now I'm talking about bank branches versus mobile cellular subscription. If you start looking at ATM penetration, it's even less in terms of Sub-Saharan Africa. It's 5 versus 73 per 100,000 inhabitants. Again, the implication is that you're not going to go out and rebuild that infrastructure. It's too late. It has been built in the West in the past 50 years. It is too expensive to do it. And in fact, I'll quote an interesting statistic here. If you look at what reasons the population, especially the unbanked population, gives for not having bank accounts in Sub-Saharan Africa, this was on the Global Findex survey of the World Bank, over 2/3 of the population quotes a bank account as being too expensive or being a luxury good for them. Now, this is preposterous. This is incredible. It cannot be too expensive because clearly the majority of the cost structure of providing such a simple product as a bank account ought to be variable and not fixed. So how can it be too expensive? You start having a very clear picture that if the dematerialized good, the quintessentially dematerialized good, namely financial services, can be distributed through the quintessentially non-physical distribution network, namely mobile telephony, you have got an obvious solution there. And in fact, I'll just tell you that the obvious conclusion from what we're seeing here in both, in both respects, from on one side the income distribution gap and the other side the call it last mile distribution network, is that financial innovation increasingly is coming out of those specific markets. And what markets are we talking about now? Everyone knows Kenya, everyone knows the M-Pesa examples. Fewer people perhaps know AFB as an example of microfinance in general. Actually, it's microlending and microinsurance, BIMA, that many of us know about. These are all new models, and we will talk a little bit more about the models that have come out of these markets out of necessity rather than purely out of innovation. And as a result, you have a combination of these two factors bringing phenomenal new products that are going out. Now, this is also brought about by enablers. Technology is a typical enabler. We will show you how the cost of technology as a barrier to entry has decreased massively over the past 10 years, making it possible to provide exactly the same services as you could through the mobile delivery channel rather than having a need for a physical channel. And this is not just true in high growth markets, this is also true in, call it, Western markets. I was reading a statistics about the UK where up until 10 years ago, the average consumer would go to a bank branch 25 times a year. This year, that statistic has gone down to 1 time per year. So hence, the closures that we have seen in recent times of bank branches. In fact, if you want, you're having a reverse path in terms of distribution channels in developed markets versus growth markets. I was referring to the income gap on one side and the distribution and infrastructure gap on the other side, and how this brings to the development of new business models. A final differentiation that I want to make is often we think of technology as the novelty. Technology, as I said earlier on, is by now just an enabler. The real novelty is new business models, and that's what we're focusing on. These are some of the numbers that you already know. The key one, as far as I'm concerned, is what I mentioned, namely that 90% of the 2.5 billion of unbanked population in the world being focused in these markets. And the fact, of course, that middle-class spending by 2030 in growth markets will contribute more than 60% of global consumer spending. This will be more than double in approximately 15 years. And as you can obviously understand, the robustness of the formal financial system is necessary in order to enable this growth of consumer spending. And this is an essential component of the consumer growth stories throughout high growth markets. So it's not going to happen unless the network, the infrastructure that we're building is actually there. And we think all of the innovation that we're seeing is actually bringing us to that. What are the enablers? The enablers are, as I mentioned, in some cases, the income gap, in some cases, the distribution gap, but those are really situational elements. The enablers are technology becoming cheaper and making barriers to entry lower. Financial inclusion, there has been an extremely strong drive, both governmental and non-governmental from NGOs, policy drive towards financial inclusion. And remember my point about it being morally, well, at least in my opinion, morally obligatory, but on the other side also a very sound business proposition. Government initiatives and regulatory initiatives. Regulations in many of the countries, especially in West Africa, East Africa, and South Asia, are significantly more advanced for agency banking, correspondent banking, than they are in large parts of the Western world. And again, this is no accident. Ultimately, regulation has driven, but has also been driven by the emergence of new business models. The M-Pesa point is an obvious one. Again, the model was born before the regulation, and eventually regulation followed and was applied in several other markets. And finally, changing consumer behavior. And this is not something to be underestimated. The consumer is expecting more. There is an awareness in literally global high growth markets from consumers to expect full financial services being provided to them and a readiness to take them on. As I said earlier on about the Global Findex survey, there are several other reasons why people have not enrolled in bank accounts, and one of them is they don't work for me. So there is an awareness of what works for the consumer.
Look, the whole concept of reverse innovation, I just flick to the next slide, is basically an innovation that's really created in a frontier market or a growth market and then spreads back to the developed markets. So, over the last, 100, 150 years, what we've seen is that innovation has largely been led in some of the classic developed markets that we're used to. What is now starting to happen in a major way, supported by a number of huge demographic shifts and trends, is in fact innovation is coming in the other direction. We are sitting in a confluence of some very interesting factors that create a ideal, or shall we call it the perfect storm, for the development of very interesting new business models in those markets. What we thought we'd do is focus on a few examples, probably the first of which is alternative banking channels. Now, all of us probably believe that alternative banking channels as a concept originated in a developed market. That is absolutely untrue. In fact, the pioneer of creating alternative banking channels happened to be DenizBank, which is a niche bank in Turkey. And they were really the first bank in the world that allowed you to access your bank account through your Facebook page. This is now becoming more ubiquitous amongst the branches. And the point of this isn't necessarily that you can access your account through Facebook. It's the fact that they recognized the spread and the importance of social media as a core channel of accessing services and bringing services, banking services, to people in those markets. The next example is in the payments infrastructure world. So if you look at the payments infrastructure, we now in the UK, for those of you who live here, know that there's something called faster payments, which is the ability to transfer money from account to account instantly. Now, most people in this room probably, or most people I talk to, think that that innovation of doing instant transfer of money from account to account originated in a developed market. Again, not true. The first real-time money transfer system from account to account originated in India. It was created by the NPCI, which is a group of banks that got together in 2008 and collaboratively developed what is IMPS, which is Immediate Payment System. And in 2010, launched a ability to move money from an account to account through your mobile phone, originated through your mobile phone. Microfinance, if we look at microfinance, and Matteo mentioned the example of Grameen Bank, so those of you who don't know, Grameen Bank was created in Bangladesh a number of years ago. Muhammad Yunus, who founded Grameen Bank, has won the Nobel Peace Prize for the work he's done there. And what Grameen Bank did was basically created a completely new way of dispersing money to people in smaller chunks, using different distribution, and ultimately proving that that model can be superior to the traditional bank model by having significantly lower NPLs. Now what's interesting is that Grameen Bank has recently moved to America. And indeed, Grameen America is one of the fastest growing financial institutions in that region. And so again, bringing the lessons learned, the technologies in those frontier markets back into the developed markets. And so finally, just one final point which underlies a lot of banking infrastructure and financial services infrastructure as we know it is credit scoring. Today in developed markets, we rely on arcane credit scoring through companies like Experian and Fair Isaacs. Those your typical credit score lags reality by weeks, months, sometimes years. So really, it's not real time. But what's interesting is you are now seeing companies like InVenture, which exist in, and InVenture is actually across both the South Asian markets and the African markets, which integrate very significant demographic and behavioral factors to get real-time instant credit worthiness analysis. So really allows individuals who are typically outside the system in the parlance of developed markets to gain access to finance through the development of a robust system of measuring it. And so a lot of discussions that are going on in the global marketplace now are about how do you take a credit rating system or a credit system that is really built 100 years ago, 50 years ago through manual processes into a purely digital world. And a lot of the inspiration and technology is actually coming from companies like InVenture into the developed markets.